Hey friends, what's up? Philip here with Points with Philip. And I'm coming because, well, a couple days ago, I was listening to a live stream debate between some content creators, and we were discussing one of the questions that came up was, how important is it to carry a balance for building your credit? And I had some opinions on how that discussion went. Basically, my opinion is you should never carry a balance. It doesn't help you build your credit any more than reporting a balance does, but it hurts you a lot because you're actually paying interest on new purchases, which we'll get into, don't do. But anyway, it got me thinking a little bit more. How can we use our credit cards to build our credit? And I'm someone who has had some experience in this. I have someone who was in the low 600s and now in 750s on the credit score rating for FICO. And I have a little bit of experience in this area. And so I wanted to talk about my experience and kind of what my advice is. Although I guess I have to put this is for entertainment purposes only. This is not financial advice. It is, but don't sue me, right? This is my experience, this is what I'm doing. And this is what I would tell someone who would ask me what to do. But before we get into that, let's go ahead and I'm going to ask you guys to like and subscribe. Doing that helps me and YouTube know that what I'm doing is helpful. It also helps more people see what we're doing here, right? And so thanks so much for doing that. And if you already are a subscriber, I really appreciate you. Thank you so much for being a member of this channel. It's been an incredible ride so far, and I can't wait to see what happens. But let's get back into the nitty gritty. So how do you use your credit cards to build credit? First of all, we can't underemphasize the impact of time, right? And I know that if you're someone who, say, your student loans haven't been paid, right? And you just got that 60-day notice a couple days ago, you don't want to hear me say this, right? Time is going to be the thing that does it, right? So now, if you have a 30-day late payment or a 60-day late payment, 1 year isn't going to make a world of difference, but it is going to make some difference. 2 years away from that late payment is going to help a little bit. 3 years is going to help even more. So the further you get removed from that late payment or that bad credit score ding, that's going to help you more and more. And so time helps. Time is the end all be all. It's not you have to wait 7 years of terrible credit and then someone's going to flip a switch and you're going to have perfect credit, right? It's not like that, but time is going to be what's going to help address those wounds, unfortunately. Now, so the longer you keep your accounts open, the better it is for you. Now, credit limits can help, but they can also hurt, and we'll talk about that down the road. Now, again, the most important thing to get out of this video, do not carry a balance. You don't need to carry a balance. You don't need to pay interest to a bank in order to build your credit. I haven't paid a dime in interest in 2 years, but my credit score has increased by nearly 100 points since then. I'm going to repeat that. My credit score has increased 100 points in 2 years, and I have not paid a dime in interest in that time frame. So you don't have to pay interest you don't have to carry a balance in order to build your credit. All right. So now that's back. Again, don't carry a balance. Now, okay. So first of all, let's get into what a credit score is and why we have to care about it. So a credit score is basically essentially a way to interpret your credit profile. So whenever you say, oh, I have to be approved for this card because Capital One says that I have a 680 and the money guy or wallet head or somebody else says that I have to have at least a 680 in order to be approved for this card. That's not exactly how it works. Now, credit scores are general guidelines based on understanding a credit profile. These scoring models take into account payment history, balances, debt to available credit, and other factors in order to attempt to predict your ability to repay your debts moving forward. So essentially, it's a calculated risk with a heavy emphasis on calculated. So with that said, generally speaking, it's more things that make lenders nervous about you are likely to lower your score. And generally speaking, more things that lenders like are generally going to make your score go up. And so that's a good rule of thumb when you're thinking about this credit advice, because there's a lot of credit advice on Reddit. If you make one single comment or claim about credit history or credit utilization, you will have an army of people automatically arguing with each other over what is the best way. And it's uncertain how these banks do this. But we do know some few things. So we're going to get into what we do know and then how we can manage that. So first of all, payment history is, so there's different categories that you need to be aware of. And for anyone that's opened Credit Karma or Experian or looked at your credit monitoring service with your particular bank, I'm a fan of American Express's service. Capital One recently reinvented their CreditWise to FICO scoring, which is helpful. You know these categories, right? The first one is going to be payment history. This is going to be the most important, and most important by weight. So this is going to be 35% of your overall score. Now, this makes sense because it's ultimately what banks care about. Are you going to pay in the future? Can be read into how you've paid in the past, right? So how you've paid in the past can inform whether or not you're going to pay in the future, right? So that's going to be very important. Now, the second important is amount of debt. That's also important, and that's going to be 30% of your score. Now, length of credit history is also important, 15%. And the last two are both 10%, so they're the least important, but still important, is the amount of new credit and then the credit mix. So let's get into what all those are. So let's start with payment history. So first of all, payment history is the highest category. Now, this is a rating that's on a sliding scale of sorts. So late payments aren't recorded to your credit history or your credit report until after they are 30 days late or longer, right? So if you are someone that's a few days late, so let's say you're 5 days late on your credit card payment. Now, you're not going to get a credit card ding if you pay it before 30 days. Now, what is going to happen is you're going to have a penalty APR attached to your balance, and that can be significantly higher than your current APR. But you're also going to possibly get a late fee penalty. And basically, please make sure that you're paying your statement balance in full in time by the due date. Now, but it's important to note what will affect your score and what won't. Now, 30-day late payments are bad. 60-day late payments are worse. And 90 days or more late payments are significantly worse. And that compounds the more of them that you have. So having any on your score will damage your credit significantly. Over time, that impact will lessen until it falls off. So I still have, I think, a late payment that's going to fall off in another year. And that was a 30-day late payment. So that's still impacting my credit, but it's not impacting my credit enough that it's keeping me from having a 750. So over time, things can heal as long as you're doing the right things over time. But it's a ding. And especially the first year, it's going to hurt if that happens. So that is important to know. Now, part of this, let's take a look at the amount of debt. So generally speaking, people in good financial health don't keep adding to their debt load. I'm going to repeat that again. People in good financial health don't keep adding to their debt load. And so people who are continuing to put money on their credit cards month after month, year after year, are going to be more risky to the banks. And that's just the way to look at it, right? That is how that happens. So now it's important to know that transactors will show balances on their cards. Transactors are the term that people use for people that swipe their cards for everything they do, and they pay their statement balance in full by the due date, right? That's transactors. Now, this means that you will show a balance and let the statement close, then pay it off by the due date. If you do this, it will always report a balance to your account and you don't pay interest. Now, if your payments aren't going to cover your statement balance, banks will know from your credit report. So if you're going to say, pay the minimum payment, that looks a lot worse to a bank. Now, it's not bad because it's not affecting your payment history, but banks will see if you're making your minimum payments. They will also see if you're making more than your minimum payments, and they will also see if you're paying your statement balance in full and on time by the due date. Okay, so let's continue to talk about utilization. So this is the one that kind of gets everybody up in arms because you see people on Reddit that are trying to strategize. Okay, if I pay this 2 days before my statement closes, is this going to help me build credit the most? No. In general, the lower your utilization percentage, the better. Now, some of the older models say it has to be less than 35%, but it's a sliding scale, right? Your utilization becomes less and less of a damaging factor on your credit report the closer it gets to below 10%. Now, below 10%, it doesn't seem to impact it that much For example, my revolving balance utilization is 7%, I feel, and so 6 to 7%. It varies from month to month. Now, if it was 3%, would it be better? Marginally, right? If I had 0% utilization, that actually could be worse, right? So you have to show a balance. You have to report a balance on your cards. So you have to tell the banks you're using the cards, right? Now, so there are two approaches to managing your utilization. Now, I hinted at one. So the first one is pay your balance before the statement balance closes to manage your utilization. Or you could just wait for the balance to reflect and then pay it off in full and on time by the due date, right? So the first, optimize your credit score in the short term. And that's what we're talking about. Utilization has no memory from month to month, at least currently. There are talks about adopting other models in the future that will have some kind of a memory for utilization, but those haven't been enacted at the time of the recording of this video. Now, so you only need to optimize your utilization on months where you're buying a car or a house. Otherwise, it doesn't really matter. So if you have higher utilization and you're applying for a credit card, chances are that's just going to mean that you're going to have a higher APR associated with your account. But that's not going to matter for you because you're not going to pay any interest because you're going to pay your statement balance in full and on time by the due date. How many times have I said that so far today? All right. Utilization. If you're buying a car or buying a house and you're trying to minimize utilization, then yeah, pay off your statement or most of your statement before the statement closes. And you'll see that date on your actual credit card statement. But everything else being equal, just use your cards. Let the balance post. Pay it by the due date. That's all you need to know. You do that, your credit score will go up. Don't worry. Like the credit history. So this one, some models take a look at this differently. So some models take the average age of credit. Some place more weight on the age of the oldest account. And then others can place more weight on how long it's been since you opened your last account. And those models differ, right? And how it impacts your credit score will differ. That's why your TransUnion score is going to be different from your Experian and your other scores, right? So here's the thing. I've opened a very significant number of accounts in the past year, and my FICO score is 745. So it matters, but don't let this length of credit history drive your decision making. I think my average age of credit is a little over a year and a half at this point. So take with that what you will. Now let's take a look at credit mix. So credit mix is one of those things where it's helpful to have a good rating in this way, but it's not going to damage you significantly. Now it's going to keep you from getting to 850, but we'll talk about that. So there's only really one way to have a good credit mix, and that's to have multiple types of different credits. So usually that means having a revolving credit card or multiple in my case, and then having an installment loan of some type. So for instance, I have a student loan, and then I also have a car loan. So that is a good credit mix. Now, the only other thing you can put on there that would change this, at least make it better, would be as if you had a mortgage loan. Now, the time that my wife and I bought this house, my wife had a decently higher credit score than I did at the time. And so she is the one that is on the mortgage. And so the reason why is because these mortgage interest rates are calculated by the lowest mortgage FICO score of the two. So basically it would have been based off of my credit score, not hers, for the interest rate. And so we ended up saving about a couple $100,000 by putting it on her mortgage over the life of the loan. So important, right? Okay, so what can you do now to build credit with your card? What can you do to make yourself in the best position possible? So let's get into that. So first of all, if you don't have one now, get a credit card with no annual fee and hold it open. So generally speaking, having more cards open for longer helps your average age of credit. Now, I have said I went ham the last couple of years, right? And my average age of credit's not doing that. It's been 2 weeks since I've opened my last credit card account. Now, so it's not the most important thing, but if you don't have it, it is the most important thing. So if you're young in the credit card game, get a no annual fee credit card, hold it open. That's going to be important. Now, the next thing, pay your statement balance in full by the due date. Now, that's the best thing for your credit. Let your statement balance post. Show that you're reporting a balance. Now, it might hurt your credit utilization if you have low credit limits, But over time, this is what's going to help you the most and be the cheapest, right? Pay your statement balance in full by the due date. Now, failing in that, there's a sliding scale. At least pay the minimum payment, right? That's table stakes, right? If you don't pay the minimum payment, then you're not going to be winning or building your credit. Now, you have to pay it, but that's not going to be building your credit exactly either. You need to pay more than the minimum payment, preferably the statement balance in full and on time by the due date. Now, so you don't need to carry a balance. You don't need to pay interest. That is not, there is not a category in your credit score that ranks how much interest you've paid the banks in the last year. There's not. You're not going to find it. So here's the other thing. Utilization matters until it doesn't. Utilization matters unless it doesn't. So just spend normally, and the banks will increase your credit limit over time, and that will impact your rating as well. So if you're worried about utilization, unless you're buying a house or a car next month, don't. Yeah, ultimately, like, it could increase your Credit Karma score by 10, 15 points, but it's not worth you stressing out about it the whole month. Over time is better. Pay your statement balance in full on time by the due date. Keep your accounts open. That's what's going to work. Now, will closing your account hurt? No, it won't. Because, that if it's a credit card account that's in a positive standing, that will stay on your credit for 10 years, right? So by the end of that 10 years, preferably, you'll still have other cards that are probably older than that one by the time that happens. So closing an old account, it doesn't matter, right? Now, if it's your only card and you close it, that will matter because you'll go from being scorable to not being scorable, and that's bad for the banks. It really depends on how thick your credit profile is in order for that to matter. But anyway, thanks so much for watching me and listening to me as I was ranting about this. That's my advice for building your credit with credit cards. Don't sue me if this doesn't work out for you, because the credit scores can change over time. But ultimately, this is what I've done, and I've had a pretty good, decent track record so far for the last 2 years. But anyway, thanks so much again for joining me, and I will see you next time.